All right. I think 2 minutes is enough time. I hope everybody is here that will be attending the call. So I think we are ready to kick it off. Um, I am going to start. Omar, can you just confirm for me that you can see my screen, please?
Yes.
All good. All right. So thank you for attending. As you know, the topic for today, valuation-based practices, when to use industry medians or industry information versus how to or when to use peer data. Seems like quite an interesting topic for all our valuation practitioners on the call. Always nice to see some familiar faces and familiar names on the call. So appreciate everybody taking the time to meet with us. Quick introduction as to who your speakers are today, the two faces you can see on your screen. My name is Madeleine Reed. I am the regional manager for Valutico for the Middle East and African market. You'll see as we go through today, although Valutico is truly global, our focus will be a little bit on the Middle East and Africa. And then with me in the call as well, we have Omar. So
Mm.
Omar, it's quite a well knowledgeable guy when it comes to the valuation space. He has a bachelor's degree in finance and investments from Georgia State University. He passed his CFA level 1 with in the 90th percentile, which all of the CFA attendees and attempted participants know is quite an interesting and very well done achievement. And then he had 3 years of experience in financial reporting in a commercial bank before joining Valutico. And he is a valuation associate with us at Valutico. And then I left it for last because it's very special mention is that he also just completed his master's in banking at finance at the University of Vienna. So congratulations, Omar, and
Thank
welcome.
you.
Thank you
Thank
so
you.
much for joining us. Okay, then just going into a quick agenda around what you guys are in for today. So we've done the introductions, you know who is on the screen today. I'm going to tell you a quick, or give you a quick introduction about Valutico for those that have never heard of us. I'll explain who we are and what it is that we do. We'll then also go straight into the meat, the reason you guys are here. We'll chat to Omar to give us some insights as to best practices. What do we expect to do when we use industry data versus peer data? Which is better, and in which circumstances would you use which one? We would have then afterwards done a practical example, but Omar and myself decided we'll just do it both at the same time. So we're going to show you and discuss some examples of industry versus peer data, and then I'm going to show you how that would work in practice as well, so that you get a good understanding of what it is that we are talking about. And then in the end, we'll leave some space for questions and answers. But I really do want to encourage you guys to ask questions as we go along. It's sometimes easier to just answer them while we are on this specific topic. I think most people have used Zoom by now, but if you go to the bottom of your page, you should have a Q&A option. Feel free to use that. You can type your question into the block. I'll either address your question directly in the text or I'll raise it with Omar and we can go into it in a bit more detail. I'll be a little bit cognizant of the time and try and answer all of the questions. If there's anything we don't get to, we'll deal with the rest at the end. But yes, please encouraging you guys, ask the questions, leave us comments, give us, your thoughts on the topics that we will be covering today. Okay, so jumping straight into who we are at Valutico. So Valutico is a business valuation software. We have been around since 2017, and our founder, Paul Resch, came out of the investment banking space. He was the analyst putting the valuations together, and he became very frustrated with the concept of how manual it is to do valuations. And I think today's topic is actually quite an interesting one, playing exactly into that step where often you're looking for industry data. It takes you days to compile this list of information, only to discover that there is no information, or there's nothing available for the industry. You could have just used an industry number to start with and save you a couple of hours of time. So Paul came up with the concept to create a tool that can help you automate and streamline a lot of the valuation steps and really bring efficiency and speed into your valuation process. As you can see, since then, we've got over 850 clients across the globe. The software caters really for any market, any type of company that you would like to value. We have clients in over 90 countries. And then our team is also truly global. So our team is based across 70 countries globally, 28 different languages spoken between the team as well. So quite an interesting and well-diverse team. So for who uses Valutico, who would be someone that could benefit from evaluation software? So Valutico is really for anybody that would like to be more efficient in the evaluation process. That could be one person doing valuations as a part-time gig and really just wanting to make it a bit more efficient and streamlined. Valutico can definitely assist you with that. All the way up to, you can see some of the current clients that we have on my screen as well. BKF, Creed Capital, FinCap Securities, some of the African companies as well. So the software caters for um, corporate finance, accountants, banking, private equity, any space where you would do valuations and you would like to bring more efficiency into your process, take manual error away. Valutico can cater for you and your team. Okay, so then finally we're getting into the hot topic of the moment. Industry data versus peer data. Omar, why is this an important topic for us?
Thank you, Morley, for the nice intro. And once again, thank you all for joining us today. So to dive right into the topic and why are we focusing on this? So first of all, relative valuation is extremely common. About 85% of Wall Street equity research relies on multiples and comparables. And the choice between industry versus peer data can have a huge impact on your valuation result. I'm sure many of you are probably aware that there can be a difference, a big difference if you're using an industry median multiple instead of a median of a selected peer group. Sometimes the difference can be negligible, but oftentimes it can be quite large. And that ties directly to the reliability of your valuation and the result. There's also a practical consideration that building a custom peer group often takes time and effort compared to using an industry benchmark, which is much, much quicker. And you need to ensure that this extra effort is justified by accuracy or better insights. So given that, it's crucial to know when to use one approach or the other to make better decisions for your evaluation.
Thank you so much for that, Omar. So just before we go into the different parameters of the valuation and where you would use the one versus the other, can you give us just a quick description and a definition of what do we mean when we say industry and what do we mean when we say peers?
Of course. An industry benchmark is typically a sector-wide figure. For example, the median EV/EBITDA multiple or EV sales multiple for all companies in the retail industry, or the average debt-to-equity ratio for the telecom sector. These benchmarks, they look at the whole industry to give you a general idea of the financial metrics. Peer data, on the other hand, that refers to metrics from a selected group of comparable firms, companies that you, the analyst, decide that are truly similar to your target company in terms of metrics like size, market growth, margin, sales growth, etc. So you might select, say, 10 to 15 peer companies and take the median of their price to earnings ratio as your reference for a market-based valuation approach. The peer group is narrower, it's more tailored, but it requires careful selection because on the other side, industry data is more broad. It eliminates any selection bias, but at the same time, it can include firms that aren't very similar. More importantly, we're not here to say which method is the best or which one is better. In fact, each one has its merits. The goal here is to understand the trade-offs between the two methods so you can apply the right data in the right situation.
Omar, you mentioned now that you're looking at something like 10 to 15 companies to make up a good peer group. So often, in Middle East and Africa, if you mention the word data, everybody on this call will go, oh, data for Africa, data for Middle East, what a pain. So often we just don't have the luxury of, having 10 to 15 peers. What would your suggestion be in that case? What would be a good number? Can we use 5 good peers, 10 good peers? Is there a magic number?
Mhm. Well, ideally, the perfect number would be from 8 to 12 peers, but I can relate to lack of data and the shortage in data. I would go as low as 5 or 6 peers, provided that those are highly comparable and they reflect the actual target company being valued.
All right, thank you. Um, do you want to chat us through a little bit of pros and cons? You've mentioned some of it already in the previous slide, but you've put a nice summary together for us of pros and cons for each of the different methods. Can you chat us through that a little bit?
Absolutely. So let's rate the general pros and cons of each approach, starting with the industry benchmark. On the plus side, it's fast, it's convenient, and most valuation platforms or databases will give you an industry average in no time. So it's very handy if you're under time pressure. And because industry benchmarks draw on a large sample of companies, the result tends to be smoother. Any outliers won't skew the median too much. So it's also useful fallback when you don't have any obvious peers. However, the downside is that companies within an industry can be very different. Think of a broad sector like tech, which includes everything from software to semiconductors. If you use a broad industry average, you might not be able to see those differences. On the other side, a tailored peer group, the big advantage is relevance. Picking highly similar companies within the same region, similar size or business model, you're getting multiples that reflect the market's pricing of very comparable assets. This gives you more confidence that the specific multiple applies to your target. Peer data also provides rich context. For example, you might see that your target's EBITDA margin or growth is higher or lower than the closest peers, which then you can justify a premium or discount to the median multiple used. The downside is that it takes effort because you have to research and justify why you picked each peer, and there's also subjectivity involved. So two analysts, they might pick different peer sets, get different answers. In fact, if someone wanted to inflate a valuation or deflate a valuation, they could cherry pick high or low multiple peers. So one must be very careful of these selection biases. So just to sum up, each approach has its trade-off. And the key to understanding those differences, this is what guides us onto when to use which approach.
All right. Thanks for that, Omar. Okay, so now going into a little bit more detail on, the different places where you could use industry medians and peer medians. Obviously, through Valutico and through the normal valuation process, we'll be looking at lots of different models, depending on the business that you are looking at, the industry that the business is in. And we fully understand and comprehend that there are way different parameters and places where this topic is relevant. We've attempted today to highlight just 3 of the places, I think the most commonly used methods and places where this really is relevant, between using industry versus peer data. So the first of those, trading multiples. What do we do here, industry or peers?
Yeah. Okay. So let's talk about trading multiples. First of all, trading multiples, to explain, those include ratios like price to earnings, EV revenue, EV EBITDA, EV EBIT, and so on. If you pull an industry median price to earnings ratio for, say, the banking sector, you'll get a sense of how the market generally values banks. This benchmark is useful to know. For instance, if banks trade around 10 times earnings on average, and you're doing a valuation of a bank and it implies 20 times. And now that's a flag to investigate. Why is your bank's price to earnings multiple higher than the average? However, that industry median also mixes big global banks, regional banks, small lenders, etc. By contrast, if you build a peer group of, let's say, mid-sized Gulf region banks similar to your own target company or target bank, the median multiple from that set might be different, perhaps higher if those peers all have higher growth, or lower if they have similar regional risks. In practice, industry and peer multiples can be quite different. I've taken the example of MTN Nigeria, one of the large telecom operators in West Africa. The 2026 expected EV/EBITDA multiple for MTN Nigeria is something around 3 times, while the global telecom industry median is closer to 5 times. At first glance, you might think that MTN is undervalued, but if you look at a carefully selected peer group of other African telecom operators like MTN South Africa or Safaricom or Vodacom, you might find that peer median is actually closer to 3 or 3.5, 3.8, somewhere around that, because it reflects shared regional dynamics like market risks or regulatory pressure or FX risks and so on.
Perfect. I'm going to interrupt you there quickly, Omar, just on the topic of what you are talking about. We're going to jump into the Valutico platform and actually show what this means and what the impacts of this would be on evaluation. For those of you that's never seen Valutico before, this is more or less what it looks like when you jump into the middle of evaluation. It's a web-based app, as you know, where you would run your valuations, both private company and listed company, you can run through the platform. There's a couple of different steps that the software offers. For today, we're going to be jumping through the steps a little bit and showing you the topics relevant to this conversation. Afterwards, I'll give you some of our contact details and you can reach out should you want to see more on the platform. So just back to the conversation that Omar, that we've just been having. So you mentioned MTN Nigeria, which is this valuation that I'm looking at. If we look at the EV/EBITDA multiple for 2026, so if we take the list of the carefully selected peers, as you've mentioned, we can see that the multiple is 3.7x for 2026. MTN Nigeria's is here 3.1 or less. But then if we look at the industry median that you can see here in the middle of my screen, it is 5.3, right? So now the question remains, what impact does that really have on our valuation? If we use the peer group, the 3.7, or if we use the industry, the 5.3, what does that do? So I'm going to jump here to the valuation where we will actually look at the output. And while I do that, I'm also going to toggle here to a different page, which is just the same valuation, where I will be using the industry median. And I'm going to jump to the valuation in that regard as well, and we can see what our outputs will do. All right. So looking at the valuation overview of MTN Nigeria, you can see there's all kinds of different models here, but we are looking at the EV/EBITDA 2026 figure. We've applied a 3.7x multiple. That is our peer median, as we've just seen. And that gives us a valuation of 10.3 billion. Okay, now I'm sure you're all quite curious to go to the other tab to see what happens there. So if we go to the other tab, we look at EV/EBITDA for 2026, and now we've applied the industry median, the 5.3x. That gives us, so the 10 would have landed us somewhere here from the previous valuation. Using the industry median gives us 14.8 billion. So that is quite a significant difference between the output of the two models, using what doesn't seem like such a big difference between 3.7 and 5.3x, but the output to our valuation is actually quite noteworthy. Omar, what does this mean for us?
Well, this really highlights why the context matters. So the global industry multiple suggests that MTN might be relatively cheap, but the regional peer view shows that it's more or less fairly priced relative to the local peers. To be fair, neither number, neither median is wrong. They simply offer different perspectives. So you might use industry multiple as a high-level reference, but you need to lean more on peer data when you're making your valuation calls in a specific region. If there's a wide gap between the two, this can be a sign to investigate. Maybe the global average is skewed by low-risk developed markets, or perhaps the regional peer group reflects emerging market volatility. So the key takeaway here is to use industry multiples for context, but peer multiples for precision when available, of course. And if they diverge widely, you need to investigate and interpret why is there such divergence.
Interesting point. Perfect. So that was the first of the different phases or elements of the valuation that we've looked at. Second one, also quite a pain to calculate, except if you have Valutico, then it's easy. But also quite a interesting and controversial topic is actually the word I'm looking for, the betas. So how would this impact the betas if you did, similar to before, the industry versus the peers?
Mm-hmm. Maybe first to briefly explain, as you may already know, beta is a measure of risk. It indicates how volatile a stock is relative to the market. By definition, the market has a beta of 1. And so if a company has a beta of 1.2, it's 20% more volatile than the market. And it also factors into the capital asset pricing model, which is usually used to compute the cost of equity for a company. So you have choices here too. One approach is that you can use an industry average beta, for example, the average unlevered beta for the wireless telecom industry, and then you can re-lever it for your company's capital structure. This industry beta is often sourced from large data sets like Capital IQ, Bloomberg, from Professor Damodaran, etc. It aggregates many firms and it assumes your company's risk. If you use it, you assume your company's risk is in line with the typical firm in that industry. Now, the alternative is to look at peer company betas. You can find a set of comparable companies and use the their median beta. Again, you need to re-lever it and adjust it for differences in capital structure. Maybe Marley, you can show us also an example on the platform for that one.
Most definitely. So talking about the betas, there's obviously a lot of moving parts in this conversation. So we'll be looking at MTN in South Africa for this example. What we've done here is we've once again compiled a list of relevant peers for MTN. You can see the MTN information here at the bottom of my page. I've scrolled past all the multiple information, and here at the end of the screen, we're looking at the beta. So first things first, the industry beta that we're seeing here is 0.57. So Omar, you made a point around, looking at the index that the betas have been worked out and calculated against. So I can see some of them, if I just scroll back to the side, I do have 1 or 2 peers here that is international that I'll be using. And I can see that they are indexed against different indexes than what I will be using for MTN. Is that something that I must take note of? Is that something that I should potentially update?
Yes, absolutely. Beta, to get a reliable beta, it should be usually measured against the local market index.
All right. So basically, I can go here into the beta calculation. I think if I go into the drop down, you won't be able to see the options here, just because of the screen share.
Actually, we do,
Can you
yeah.
see it? Okay, great. And I can then select the most relevant index for me, which in this case would be the emerging markets index. So I can then update that, and we can see that that would update the beta calculation as well, because of course we're changing the index return here. So something that is possible, also something that you must consider in, context is king. We keep saying it. Is this necessary? What is the context of your valuation? And then you have the feature and the functionality to update it if necessary. So I'm just going to go back to the side here. So as I've mentioned before, we have the median of the peer group, which is 0.57. And then we have the MTN the MTN beta, which is 0.54. So you can see that the betas are quite closely aligned, and that would be almost what you expect when you have a peer group that is similar risk profile, similar markets than the one that we are evaluating. The industry median, however, is quite a bit lower. It's 0.22 here at the bottom. So let's see what that does to the valuation. While I toggle away, Omar, Is this something that you expected to see, quite a low beta for the industry?
Honestly, it usually happens that the industry median is quite different than the peer group selection. But exactly for what you said, the company can be a mature company versus a company in a scale-up phase or a startup. So uh, usually the smaller the company, the higher its beta because it's expanding, it's growing. So its returns are more volatile compared to the market. So selecting the perfect peer group, this is very much relevant in that case.
All right. So I jumped before we'll look at the valuation output. I came to a step here, and I'm just going to zoom one out, where we look at the WACC calculation. So as I've mentioned, this is the valuation for MTN South Africa. So you can see our WACC is put together here, our weighted average cost of capital with South African-based parameters like the tax rate, the market risk premium, etc. I'm looking at the unlevered beta, and if I scroll down, you can see a couple of functionality or features that we've got here. Firstly, we can select to use the peer group median, or you can use the industry median. And that's what we're going to be doing today, and to see what the difference would be there. But what you can also do is you can decide to change the time horizon and the intervals. So you can look at 1, 3, or 5 years, weekly, monthly, or daily betas. So I had a conversation with a client not so long ago, and he mentioned to me that they like to use, shorter period betas, especially for the tech industry. Omar, is there a specific reason that we use the 5-year monthly? Is it something that's sort of best practice? What time frame do we generally suggest to use? And while you answer, I'm just going to set up the two valuations, one with the peer group and go to valuation, and one with the industry and show you the outputs.
Well, the most typical time frame used is 5 years monthly, but also some of our clients, I've noticed some people like to use 3 years, and some also like to have like a weighted average of 5 year monthly and 3 years monthly. Simply, they want just to reflect a more recent trend in the company returns and the market returns.
Great. All right, so back to the valuation. I'm showing you now just a different version of the exact same calculation of the discount rates, the WACC. So you can see this one is where we'll be using the unlevered beta of the industry. So that was the 0.22, and that gives us a WACC of 14.2. So if we have a look at, I'm going to have a look at our DCF model to see what that did for us. So if we look at the DCF here, zoom one back in, you can see we have an output of 274 billion rand. If I go back to the peer group beta, which was obviously a little bit higher than the industry, you can see what that does is give us a WACC of 16.8. So that would make sense to us. The more volatile the market is, the more risk it carries, the higher your discount would be that you apply. And that then gives us an output on our DCF of 227 billion. So there's a difference of about 50 billion rand between the two valuations, just with that small change in the beta, which is also in the beginning of your WACC graph. But it just shows you that really every number matters and counts, and that you need to make sure that what you are putting into the valuation does make sense to you. All right. Anything else to add on the betas, Omar, just before we move on to growth rates?
Well, thank you for the demo. Yeah, just finally, maybe the best practice is just to match your beta to your investor base. So an industry beta gives you a quick, generic risk measure. A peer median is more informative, especially in capturing local market risks or a particular subsector's risk. For Middle East and Africa valuation, we often lean towards local or regional comparables for beta. But oftentimes there's a lack of data. So we might also use the industry average, but then we adjust it to reflect higher volatility in those developing markets.
Great. All right, then on to which is the last one of our points that we'll also be showing practically on the platform, growth rates. So quite an interesting topic, obviously, because there's no set way to know what the growth rates of a business can be. It can vary depending on the business. Can you tell us a little bit around what to look out for and how to check if the growth rates actually make sense?
Yeah, absolutely. Maybe to start, sales growth rates, they're key inputs for projections and for valuations in general, especially for DCF models and also to understand multiples, because multiples they implicitly incorporate growth expectations. And there are a couple of angles. One is that the industry overall growth trajectory, and the other is the specific company or selected peer group growth. That's if you don't have a ready-to-use projection, or if the company doesn't have a projection or forecasted business plan. So industry research from sources like market reports or even World Bank data, they might tell us that, for example, the telecom industry in the Middle East and Africa is expected to grow around 5% annually in the coming years. In more mature markets, telecom might only grow at 2 to 3%. So these benchmarks are useful as a reality check. If someone projects 20% long-term growth for a mature telecom company in a saturated market, you could say that it's unrealistic relative to the industry fundamentals. However, individual companies, especially smaller or expanding ones, they can outpace the industry for a while. That's where peer data and growth is insightful. If you have a high growth company, look at how similar companies are growing. Are their peers doubling revenue, or is the peer group also modest single-digit growth? For instance, SMEs or startups, they can have much higher growth rates than the industry average because they're capturing market share or they're entering new markets. Let's take a local example. Consider Fauri, a fintech growth company in Egypt. The overall global financial services sector is somewhere, the growth of the sector is somewhere between 8 to 10%. At the same time, Fauri has been growing at 30 to 60% for the last 3 years, and it's also very volatile in the next few years as well. So if you rely only on the industry expected growth, you'd undervalue the company's potential. Conversely, if a mature company claims it will grow 50% a year, but even the strongest peer is growing at 15%, then you should definitely question that. And then when it comes to terminal value in a discounted cash flow model is the long-term stable growth rate. And we often do anchor this to something like the long-term industry growth or GDP growth. Here, actually, industry benchmarks are commonly used. For example, you might cap the terminal growth at the economy's growth rate around 3%, or the industry's expected long-term growth. So this is to be conservative and realistic. So no company usually grows faster than its industry forever. So in summary, you can use industry growth rates to ground your long-term and big picture. But you can also use peer and company-specific growth data to inform about the near to medium-term projections. Keep in mind that the region matters. So telecom company in Africa is growing faster because the industry in Africa is generally growing faster. Probably more than a telecom company in Europe is growing. And within that industry, a particular company might grow even faster if it's especially well positioned in the market. So you need to just cross-verify that with similar growth stories in the peer group.
All right. So Fauri was the example that that you mentioned now that we were going through. Fintech company in Egypt, very exciting, growing at a rapid pace. So we're going to do two things here in comparison is we're going to look at Fauri's growth in comparison to a global outlook or a global industry once again. So if you have a look at the business plan, this is where we've uploaded under financial projections the actual financials of Fauri. It is a listed company, so this is obviously publicly available information. And what we are now doing is we're looking at the net growth, sales growth of Fowry in comparison to financial services globally. What you can see here is firstly, very impressive growth over the last couple of years. I'm sure the shareholders here are smiling all the way to the bank. But then, like you rightfully mentioned, very exciting growth ahead, but also very volatile. Often us as practitioners, when we do evaluation, you get this financials from the business owners who obviously are very optimistic about their next unicorn business that's going to shoot the lights out. And it's your responsibility to make sure that that is the case and help them get there. So I'm going to be honest, if I uploaded this financials from a private company and I looked at this compared to the global growth scale, I would think that something is definitely wrong here, right? It seems very high growth for a listed company in comparison to what is being achieved globally. But then what we've also then done is just to sense check ourselves once again. We selected a group of peers in a similar space, similar industry, similar risk profile, and we had a look at what their sales growth was for the last couple of years as well. And it's this chart here in the beginning of my page, and you can see very nicely that there are actually companies doing better than Fowry as well. Can you believe it? So overall, when we are then looking at a selected group of companies, that's even though it's not that many, it's a way more, shortened list than the industry number. We see that these growth percentages are definitely possible. So once again, nice to have the tools to be able to do both, to make sure that the numbers make sense, the growth that the businesses are able to or hoping to achieve is actually a realistic. And then, as you've mentioned, also nice to look at what the growth rates would be. That would be different per market. So looking at what more established businesses in Africa are achieving in a long-term growth versus maybe the Middle East versus Europe, and then coming up with a long-term or terminal year growth number that makes sense for your business. Yeah. Anything to add to this growth step, Omar?
No, you've illustrated it perfectly.
Perfect. Thank you. Um, so that is basically the end of our demonstration. We actually went through it a little bit faster than I think we expected to. As I've mentioned, of course, there were a ton of more examples that we could have used for the industry versus the peer groups that we used in our valuation process. I haven't seen any questions, but if there are any questions coming in, please feel free to raise your hand and we can take them and address them now. Also have a re-look at some of the things that we have discussed if anything went a bit faster than expected. Just before we do take questions, a quick reminder for those that haven't heard, we are running a very nice special bundle deal on the Valutico platform at the moment. Some cool promotions going around. Please feel free to reach out to me. My name is there, my email and my cell phone number or WhatsApp number. You can also scan the barcode, which is very cool, and that will direct you to me as well. We would also love to hear from you, suggestions for topics in the future. Did you find this interesting and useful? Any comments would be very much appreciated as well. So feel free to reach out to us with any of your thoughts. Right, I'm going to give it a minute for a question or two. I'm assuming Omar just explained himself so well that nobody misunderstood anything. Everybody understood everything quite well.
Thank you. Well, I also wanted to mention one last thing because sometimes it's a nice fallback to go to industry benchmarks. And when does those benchmarks are your only viable option? And this often happens with SMEs or very niche businesses. Think about a local auto repair shop or a landscaping business. These kind of companies, they usually are privately held or family run. So you often don't find a direct comparable price to earnings or EBITDA multiple from the market for Ali's Auto Garage in your town. In emerging markets, the problem is even bigger because many sectors are underrepresented on the stock market. For example, you won't find a dozen listed auto repair companies in the Middle East or Africa. Almost all of them are private. In such cases, you can actually fall back on industry benchmarks, and you can drill down on sub-industries as well, which you can easily find on Valutico. For example, these are the kind of multiples or private transaction databases, sometimes compiled by brokers, analytics firm, or firms like S&P Capital IQ. And they can tell us, for example, that this auto repair shop tend to sell at about 2 to 3 times their net income. And actually, this is a real case that industry experts, they often cite 2 times to 3 times as a typical multiple for a well-run auto repair shop. So if you're valuing an auto garage in Dubai with 300,000 of net income, you might say that the business is worth roughly 700 to 900,000 based on this rule of thumb. So without any public peers, industry benchmark can be really useful. And also, if not local, then you can draw on a larger sample from North American or European data, but then you have to adjust it for the local condition and local risks.
Thank you,
Do we
Omar.
have any questions?
We have one question from Virgil. He's asking, just does Valutico collect industry and peer data, which we can use, or do they need to do their own research? Do you want me to cover this question? Maybe I'll tell you, Virgil. Yeah, so Valutico has many data integrations and APIs with databases. We pull all of the data that you've seen in the demonstration today into the platform. So everything from the listed company comparables. We have a section that we didn't go through, but that's private transaction comparables as well. All the different elements of the beta calculation, the tax rates, market risk premium, all of those parameters we have integrated databases and data sources with. So the only information that we would require from you onto the platform is the financial information of the business that you are valuing, that you can upload using an Excel spreadsheet, but then to run all of the valuation models gets done by Valutico for you. Right. I hope that answers your questions sufficiently. If not, pop me an email and I'll very happily show you how that would work as well. Okay, I'm just going to give it another 30 seconds for a question or two. All right. Yeah, so I don't think there's too many questions left. So Omar, just to wrap up again, once again, it's an interesting topic of which the answer is there is no right answer. As practitioners, I think we are encouraged to really look at the context of the valuation, who you are doing it for, what you are doing it for, and then make the decision that's the best in your regard. And then obviously for Africa and Middle East, the data is also quite scarce for us. So thank you very much for your valuable insights, all the learnings that you gave to us today. Hopefully we'll have you on a webinar again soon.
Thank you very much, Marley. Thank you, everyone.
Perfect. Thank you then all to everybody that participated in the webinar. I'm going to put the contact slide back on again, so feel free to reach out to us. And otherwise, I wish you a lovely rest of your day.